Hello, welcome back. We are in Chapter 6, and one of the main topics in Chapter 6 that I think is pretty challenging for a lot of students is doing a bank reconciliation. Bank reconciliation is something that every business should be doing every month as a matter of routine. Let's talk a little bit about bank reconciliation. I have a simple setup here showing basically dividing the page in half, two columns. On the left side it shows per bank, and on the right side it shows per books. Now, what is a bank reconciliation? Why do we have to do a bank reconciliation every month? Well, as many of you probably do yourselves for your own checking account, you find that the balance in your checkbook or your check register is almost always different from the balance that the bank shows for your account. And there are a number of reasons for this. Probably the more common reasons are what we call outstanding checks and deposits in transit. An outstanding check is a check that we have written on our account. We have sent it on to the payee. We deducted it from our book balance, and for one reason or another, the bank, at the time that we look at it, let's say at the end of each month when we do our bank reconciliation, at the time that we look at our account in our records versus our account according to what the bank shows, the bank does not show a deduction for that check. And the reason is quite simple. Checks often take some time for clearing our bank. In other words, we're going to write a check, send it to our vendor as a payment. Let's say the vendor is going to have to receive that check. It may take a few days or longer. The vendor will have to receive that check. The vendor will have to deposit that check into their bank, and their bank will have to send that check to our bank for payment. And so usually it takes a few days, sometimes longer, for that to happen. So that would result in an outstanding check, a check that we have written, deducted from our books, but has not yet been deducted by our bank from our account. Another type of transaction that is common, which shows up on most bank reconciliations, is called a deposit in transit. Now, that's similar to an outstanding check, except it's not a deduction from our account. It will be an addition to our account. And usually it happens around the end of the month. Let's say the last day or two. We may have accumulated our cash receipts for the last day of the month, perhaps a couple of days at the end of the month, and balanced our cash, prepared our deposit, and added that cash amount for each of the days involved, added that cash amount to our cash balance on our books, added it to our check register, and added it to our cash ledger account balance. The actual deposits may not reach our bank for one reason or another until a day or two later. And so if we're working with deposits from the 30th and 31st, let's say, those deposits may not get to our bank until the 1st or the 2nd. We don't want to have a whole lot of time between our receiving cash and getting it into our bank account. But sometimes it may be a weekend, or it may be a holiday, or it may be some reason beyond our control where the deposit doesn't actually get into our bank or get to our bank for deposit until the beginning of the next month. So that would be another example of a reconciling item between what we show in our books and what our bank shows on their records. A deposit in transit. We have received the cash and properly added it to our cash records. However, the bank would not have received the cash until the following month, and so would add it to our account when it receives it in the following month. And so our bank statement for this month will not reflect that deposit, or if it's a couple deposits, those deposits would not be reflected on our bank statement for this month. That would be a deposit in transit. There are also a number of other types of transactions that result in differences between our cash record and the bank's cash record. Probably another very common type of transaction that occurs in most accounts on a monthly basis would be a bank service charge. So the bank is going to charge us some service fee for their handling our checking account and all the transactions that are involved. And so the bank would add that charge. That's a bad way of putting it. The bank would actually deduct that charge from our account, and it would show that charge on our bank statement and send it out to us at the end of the month. We generally don't know how much that charge is going to be. Most times it's going to fluctuate a little bit. Banks usually charge fees for checking accounts based on the volume of transactions in the account. So the volume goes up, the fee would go up. The volume comes down, the fee would come down. Not all banks handle it that way. Some banks charge a set amount, but it varies. And so we would not know the amount of that charge to our account until we received our bank statement. At such time when we receive our bank statement, then and do our bank reconciliation, then we know what that charge is, and we can enter it into our books as a reduction of our cash balance for bank service fee. So again, that would be another example of a transaction that would require, that would result in a difference between our cash records on our books and the bank's cash record of our account on their books. So, that said, why don't we work through one of the problems in the chapter for bank reconciliation. And I think problem PA 6-2 is a good one. I'm not sure how long this is going to take us, but let's see if we can work through this and come up with the correct answer. So on page 296 of chapter 6, problem PA 6-2, preparing a bank reconciliation and related journal entries. The bookkeeper of Martin Company has asked you to prepare a bank reconciliation as of May 31, 2010. So our bank reconciliation, I'll just show the date here. This would be as of May 31, 2010. And we have our bank statement, and we also have our cash account ledger balance. Those are the beginning points, the beginning balances for our bank reconciliation. By the way, in the chapter, the chapter shows you an example of what a bank statement looks like. I think most of you have checking accounts, and so you probably have a good idea of what a bank statement looks like. But if you take a look on page 264, there's a picture of a sample bank statement. Bank statement, aside from the identification information at the top, is basically going to show you the beginning balance, the balance of your account at the beginning of the month, the balance of your account at the end of the month, and all of the transactions in between. All of the deposits that have been received by the bank, all of the checks that you've written that have been paid by the bank, and all of the other types of transactions that may have affected your account either in the positive or in the negative. So again, page 264 shows you a sample bank statement. Getting back to the problem. Let's see. It says Martin Company's bank reconciliation at the end of April 2010 showed a cash balance of $18,800. So since that was our reconciled balance at the end of April, and that should be our beginning cash balance for the month of May, $18,800. No deposits were in transit at the end of April, but a deposit was in transit at the end of May. So they show a T account for cash, and our May 1st balance is $18,800. They also show a number of transactions in our cash account, either on the plus side, on the left side, and those would basically be deposits, or on the right hand side, the negative side, and those would basically be our checks. So we have written 5 checks during the month of May, checks 301 through 305, and we had 3 deposits during the month of May, on May 1st, May 7th, and May 29th. And again, it said that there was a deposit in transit at the end of May. So our May 31st balance, according to our records, and again, taking a look at the T account shown in the problem, is $17,400. So we would start with that balance on our bank reconciliation on the book side of the reconciliation. The problem also shows us a diagram there of our bank statement. It's just a simple diagram. It doesn't look like the sample statement shown in the chapter, but it gives us the essential information. And our bank statement bank balance, cash balance, as of May 31 shows a balance of $14,480. So that will be our beginning point for our bank reconciliation, $14,480. That will be our beginning point for our bank reconciliation on the bank side of the page. So again, we're starting with balance per bank of $14,480 and balance per books of $17,400. And the objective of our bank reconciliation is to show adjustments on either side of the page here. Some adjustments will affect our bank balance, other adjustments will affect our book balance, and the objective here is to come up with an adjusted cash balance on both sides of the page that is the same on both sides. And with that, I'm going to take a short break and come back to this problem.